Would a central bank hike rates during a bad recession? You'd think there's no way that could possibly happen. But it has happened. It is happening right now. Interest rates around the world want to go lower because they are reflections of lower growth and inflation expectations. Everyone is trying to dismiss that signal because they don't like what it means. Not with inflation narratives running rampant and booming reflation trades being booked by brokers everywhere. Rates would be going a lot lower if central banks would get out of their way. But one central bank that is getting more in the way is the Bank of Japan. That one is bucking the global trend by raising its short-term rates and having done so for the first time in forever back in March. The Japanese government, however, they just today confirmed that Japan was already in recession throughout the entire second half of last year, and that recession actually got worse during the first quarter when the BOJ hiked its rate policy. Here's how Bloomberg described the latest data we got from Japan on, yes, contraction in GDP, and a pretty big one. Japan's economy shrank in the first quarter as consumers and companies cut spending, extending a dismal performance that stretches back to last summer and complicates the picture for the central bank as it molds the timing of its next interest rate hike. And I don't think that's necessarily the case, that last part. The first part is absolutely true. Japan's economy has been an absolute mess for now 3 quarters running. And there's really not much of a sign it's going to turn around. We'll get to that in just a moment. However, the Bank of Japan is raising rates, and it has come up with some justifications for why it's raising rates. But the real justification, well, here, let me read you something for an economist who I think is getting closer to the truth. Toru Shuhiro, chief economist at Daiwa Securities, said the yen's weakness complicates the question of whether the BOJ should maintain its monetary stimulus, which is not stimulus, or continue to unwind it. The adverse effects of a weaker yen are becoming a cause for concern, so one can argue that interest rates should be raised. That's it in a nutshell. The central bank is not raising rates because the economy and the fundamentals of the economy are calling for it. They're raising rates for the typical non-economic, clueless reasons. Policy, politics, not economics. What's really happening is the Bank of Japan is being pressured to raise rates to do something about the yen. And their thinking is that higher rates somehow help the yen when the fundamentals of the yen don't line up to that at all. And the yen is weak because Japanese fundamentals are horrible. And Japanese fundamentals are horrible because it's a globally synchronized world. And it's a globally synchronized world in 2024 because the world is still on the downside of the supply shock. Yes, the business cycle. Japan is evidence of the same cycle that we're experiencing here in the United States or in other places around the world. It isn't done just yet. And in fact, in many ways, it can continue to get worse. So Japan is hiking rates during a recession when interest rates would rather go in the opposite direction because of the actual fundamentals of this same global cycle. And because of that, the Bank of Japan is hiking its rates for purely political reasons. They've crafted these justifications that sound like they're perfect for the Japanese economy that they see going forward, starting with inflation risk. They see inflation risk because Japanese companies are going to be raising wages for the first time in quite a long time, and therefore that can contribute to the spending power of consumers who they also believe are going to start splurging because there's been so much pent-up demand for so long that consumers have to spend. So they're worried about the economy moving forward because of wages and spending leading to potentially an inflationary wage price spiral when there is absolutely no evidence for either one of those. Either the wages or the spending, as we'll see in just a moment, on both accounts. They also consider the fact that, like many people in the mainstream media, they believe the world economy is on an upswing, that we're going into a reflationary period, which will further contribute to the inflationary pressures that the Bank of Japan sees. But then why, again, is the yen getting weaker? But essentially, they've made an economic case, but it just doesn't stand up to any scrutiny or evidence because there isn't any evidence. And the reason the yen is going down is because those assumptions are all wrong about the globally synchronized economy, and especially the downside, the continued downside in the cycle. So either the Bank of Japan is being disingenuous because of political reasons, pressure from the government to do something about the yen, or they're clueless on the economics. And the fact of the matter is, it can be both. They are not mutually exclusive. They can really believe that the economy is experiencing the nascent stages of inflation. At the same time, they're getting political pressure to do something about the yen. And they don't really care to reconcile how all of these things seem to be contradicting everything that they're doing, including raising rates, getting in the way of lower growth and inflation expectations as Japan experiences lower growth and soon to be lower consumer prices. So if there's all this political pressure on the Bank of Japan, and there certainly is, we've seen that. Just Governor Ueda's recent visits with the Prime Minister of Japan, who is incredibly unpopular over there now. Suddenly, Ueda's tune changed and said, "Oh, I need to be more hawkish here. I need to talk about the yen." But essentially, there's been obvious political pressure put on the Bank of Japan to do something about the yen, which only goes to raise the question again: why is JPY so weak? And according to the Japanese government, especially those officials in the Ministry of Finance, it's for nothing. There's no reason why the yen should be so weak. Vice Finance Minister for International Affairs Masato Kanda back in March said, "The current weakening of the yen is not in line with fundamentals and is clearly driven by speculation." That's a common tactic you get from officials all around. Whenever there's some market price or indication that goes in the wrong direction, it must be those darn speculators, evil speculators, betting against the good of the government's trying to do. And that message was reinforced repeatedly out throughout the last month and a half, really since the yen got as weak as it has been, including a Japanese finance minister, Shunichi Suzuki, who told Parliament on April 1st, and this was no joke, "As for the yen's recent declines, we believe there are some speculative moves that do not reflect fundamentals when taking into account domestic and overseas economic as well as price developments." Because again, they really see Japan's internal economic fundamentals as positive, favorable. They've defeated the deflation monster that had plagued the country for 3+ decades. They've got everything going in the right direction. Ultra accommodative policy finally accommodated something after 20 some years of trying. At least that's what they believe. And on top of that, the same thing is all the reflation trading. The idea that growth is picking up, that demand is picking up around the world, and Japan will benefit from it. So there's no reason in their minds and their analysis why the yen would be weak. And the answer is staring them and us right in the face. The reason the yen is weak is because they've got the fundamentals all wrong. If the Bank of Japan and its economists got the fundamentals all wrong, what about the fundamentals all around the rest of the world, as expressed by the mainstream media and other central bankers who are nothing more than the same economists? The dollar, financial markets, interest rates, they're telling you they've got the fundamentals all wrong. And we've got enough evidence for it that the case just simply falls apart. It goes back to either clueless central bankers or political pressure, likely the combination of the two. So let's get to the most recent data. The government in Japan just reported GDP figures for the first quarter of 2024, and they were not just ugly. They were ugly, but they were uglier than even most analysts were expecting. Downside miss all across the board, especially household consumption. Investing.com put it this way: the Japanese economy shrank more than expected in the first quarter of 2024, hit chiefly by a slowdown in consumer spending amid sticky inflation, not really inflation, and sluggish wages, while capital spending also slowed. Remember what the Bank of Japan has been saying. Wage gains are going to lead to personal consumption spending. We got neither of those in Japan. So it just further exposes not just the fallacies, but everything else that's going on. Central bank policy rates are driven by things other than what's happening in the real economy. As the Japanese had reported earlier, average cash earnings among Japanese workers They had slowed down dramatically in March from the earlier months of this year. Really, January had been the best month, but ever since then, average cash earnings have been slowing down. So, no sign of this wage acceleration that everyone has been talking about, especially after they hyped up union wage increases a couple months ago when justifying the rate hike, when union wages in Japan represent a very small portion of the overall workforce. Overtime earnings actually contracted sharply. They were down 1.6% year over year in March after falling 1.5% year over year in February. And what we're seeing from Japanese businesses is the same thing we saw in 2018 and 2019, the last time Japan was in a recession, a declared recession, actually. They cut back on bonuses and in overtime as they might increase the level and pace of regular pay. So Japanese businesses are indeed giving raises, regular raises to their workers, increasing their regular pay, but at the same time they're cutting back in other ways. Non-regular forms of compensation. Bonuses are way down, as are overtime earnings. Again, as I said, we see this behavior during recession. But the big one, that was GDP last night. According to the Japanese government, GDP was down quarter over quarter by 0.5%, or just above a 2% annual rate. Furthermore, they revised the last couple of quarters lower. The fourth quarter was reduced from a very small positive to a much smaller positive, which was practically zero. It was positive at 0.004%, which is basically flat in the fourth quarter. And the third quarter was revised even more negative from 0.82% quarter over quarter to 0.91%. And those are quarter over quarter. These are not annual rates. So what that means is that, according to GDP, Japan's economy has been in recession for 3 solid quarters. Maybe it's not 2 quarters in a row. Doesn't meet the technical definition of recession, but the technical definition isn't actually a definition. Japan has been in recession since the middle of last year, and it has been a solid recession since the middle of last year, and yet the Bank of Japan hiked rates anyway. The primary reason, or one primary reason why Japan has been in recession, consumer spending. Consumer spending in Japan has been solidly negative for 4 consecutive quarters, an entire year. Where's all this pent-up demand? Where's all this pent-up desire to spend and spend and spend? It's not happening. Japanese households are continuing to retrench, and it shows in the GDP figures. They've been down 2% on a real basis, down 2% year over year in the first quarter. So there really is no pent-up demand, especially after 4 consecutive quarters of the same types of deep negatives. Other parts of GDP suggested trouble on a global front, including trade. Exports in Japan finally fell by 5% quarter over quarter in the first quarter. For some reason, the Japanese government, the Cabinet Office, which tracks GDP, has suggested that exports have been far better than other parts of the Japanese government, including the Ministry of Finance, which keeps track of exports on a volume and monthly basis that look nothing like what the GDP statistics look like. And if we use the Ministry of Finance numbers, then GDP over the last year would be even worse than it appears already, because exports would have been far lower, especially on a volume basis. Imports continue to decline in Japan because the Japanese economy, well, it's weak. And it's weak because everything costs more because of the supply shock. It's not inflation, it's the supply shock, and it's leading to the downside cycle that Japan is now experiencing to the fullest extent. So we look at trade. Trade actually suggests the situation is even worse, that the other assumption that's going into the Bank of Japan's rate hikes, the reflation of the global economy, that's not happening either. And on top of everything, business investment in Japan, that continued to fall, though that's really been back and forth over the last year. But what that goes to show is that Japanese businesses, in addition to cutting back on other forms of pay to their workers, they're also restraining investment. They are not buying the strong economy narrative or reflation either. They're putting their money where their mouth is, or they're putting their money where their yen is, which is the economy continuing to go down and exhibit all of these bad fundamentals. And some of this is contrary to other forms of mainstream economic theory, too. Just one last point on GDP and the recession in Japan, and that is we shouldn't have recessions when unemployment is low. According to many central banks, in fact, they're all central bank in economic theory, the Phillips curve, when unemployment rates are low, that should be inflationary. Again, that's one of the reasons why the Bank of Japan is saying we need to hike rates, because the unemployment rate has gone even lower in Japan, like in other places around the world, at least last year in the US. Yet, no inflation. We've got recession in Japan, a prolonging recession in Japan, even though the unemployment rate is indeed low. In fact, again, we saw this last time around in the last cycle back in 2018 and 2019, when the unemployment rate then had set a multi-decade low at that time. And again, Japanese officials thought this was going to be inflationary. They started to think about ending QQE and raising rates, but they never got that far because a recession developed in late 2018 into 2019. Economists don't seem to have a good handle on either inflation or the economy, and the central banks set their policy rates based on not having a handle on inflation or the economy, or in the case of Japan, also the currency, the global fundamentals. So the Bank of Japan is hiking rates because of its clueless economics as well as pressure over the yen. The yen is falling because the fundamentals of Japan and the rest of the world are not the fundamentals that these central bankers see. The real fundamentals. The weak yen is telling us globally synchronized, cycle, downside of the supply shock. It's not going away. It might actually still be getting worse, which is consistent with data that we're getting from around the rest of the world, including recently here in the United States. Central banks are in the way of interest rates because central banks set policies based on non-economic or just plain bad reasons. And Japan is a prime example. Interest rates around the world want to go lower and will go lower if or really when central banks get out of their way. And lower interest rates are lower growth and inflation expectations, which, if you haven't noticed, that's exactly what we keep getting, and not just in Japan. We can see the yen's fundamentals in long run as well as short run periods and how those relate to the rest of the world. And that's the video I've got linked below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. Until next time, take care.